Welcome back to another edition of Special Situations Investing with Greg Miller. And this week I completed two of my special situations that I was investing in with CCUR Holdings or CCUR Holdings. I don't even know how to say that. And then the other one is Sallie Mae. And for those of you that are baseball fans, I batted 500 on this. You can see my mistake and you can see my success. So check it out. Hey everyone, welcome back to another edition of my YouTube channel on Special Situations Investing and my personal investing practice. As a quick disclaimer, this video is for educational purposes only. Any companies that I mention in this presentation are discussed solely for illustrative purposes. Discussing such companies and the specifics about them is to help educate me and educate you about certain special situations. It is not a solicitation to purchase them. I recommend that you conduct your own research and identify why you might want to own the company yourself prior to your committing of any funds. I also recommend that you seek the services of a financial advisor that has considered your personal situation as your fiduciary. And then finally, may your education here grow your knowledge, improve your personal investing performance, and give you the confidence to take control of your future. Thanks a bunch for watching. Now on to the video. So the two different transactions that I did, first was I'm going to go on the bad news for me. It's CCUR Holdings. That one, they had a going private transaction that back in December they advertised that they would pay anyone that has less than 3,000 shares $3.06 per share. And well, I went ahead and got into it thinking that I would be able to do that because there was about a 5% return difference on that. And I jumped in on it, and they came out with an amendment this week. And the amendment this week stated that they would only pay $2.86 per share for anyone that has less than 3,000 shares. Well, I don't like to stick around for disingenuous management, so I went ahead and sold out of this one. I took a loss. The loss was about 2.8%, and it was about $500. Not a big deal, but I didn't want to stick around and wait for them to management to treat me fairly, and so I didn't. I was thinking back on this one and trying to understand why. You're the little guy when you're investing this way sometimes, and so you just have to accept the loss, and that's how I'm going with this. I'm accepting the lumps, and I'm not going to stick around for them to do this. Now, I could technically stick around and just participate in the going private transaction for $2.86 per share, and my entry price was about $2.88 per share. So there is the possibility that I wouldn't lose. I would lose less than 1% on the transaction. However, in my view, the amendment itself did not have a date as well for the transaction, and I'm just not ready to sit around and wait for them to tell me that they're going to treat me fairly on this one. So I'm not saying that they're doing things terrible or anything like that. It's just, hey, it's the nature of doing special situations investing, and sometimes you're just going to have something that causes you to take a loss once in a while. So yeah, if you wanted to, or if somebody wanted to, I'm not doing this personally. Like I said, I got out of it completely. But if you wanted to, you could technically buy another share and then force them to put you into the private position. Now, with one caveat on that, part of the reason why I didn't do that is because I am not an accredited investor, and in order to be in private equity, you kind of have to be an accredited investor. So just to be aware of that if you decide to take that route. Maybe someday I might push that towards them, but I'm not about to spend my time focused on that. It's not worth my time. There's too many other opportunities out there right now. So The second special situation that I got out of this last week was Sallie Mae, or SLM. Sallie Mae had a Dutch tender offer that was going out for up to $15 per share for the shares that are outstanding, and they were buying a significant portion of their outstanding shares. I think it was approaching 20%, if I remember right. I know it was over 10, but it was a significant amount. And I went ahead and bought in when they first announced it, and you can see it. I'll post to a link on this. But I went ahead and started getting out last week at $15.25 a share. It was about a 4 or 5% return. Not bad, but the problem was well, Friday and today I could have sold out at closer to about $16 a share, and I went ahead and did that and finished my sales, getting out at approximately $4.69%, and for a net gain of about $300. So overall, my return between the two, both Sallie Mae and then CCUR Holdings, turned out to be a net loss of about $200. But it is what it is. I'm learning in the process as I go through this. I might be a little bit more stingy on my money when I go into these going private transactions in the future. Conducting the post-mortem on Sallie Mae, I can't kill myself for making mistakes on this one. I mean, I did get a gain out of it, so it's better than a loss, which is always, in my perspective, is always a win. But I was trying to understand why this return, I could have gotten that 10% return, but I was trying to understand why that 10% return would have been available, because I've seen this same trend with Sallie Mae. I'm seeing it now with Seneca, which I'm still in, by the way, and probably will get out sometime this week. And then I also saw it with AMCX. And I think what is going on with this is that you have these brokerage firms, your TD Ameritrade or your Fidelity, and they come through and they require you to basically lock up your shares 3 to 5 days before the transaction completes, so that they can make sure that they get those that are participating in the transaction, get them their cash and get them into the transaction. Well, I think really what happens is it lowers the volume of shares that are technically available to trade at that time. And so the post announcement or post requirement day for your TD Ameritrade, your Schwab's, your Robinhood, even all of those brokerage firms, once they say, hey, if you want to participate in this, you got to let us know by this date. Well, that's going to cause less shares to be available after that date that they have, and so the subsequent rise could potentially be the reason why because there's less shares out there and available to trade. I don't know if that's true. This is just my thoughts from my observations. So my observation, it's totally empirical evidence. It's observing 3 different tender offers that have gone through it. So don't spend your time or think that is exactly what is happening all the time. It just makes sense to me, and the universities don't really care about this area usually, and so you're probably not going to see a lot of data on this. So anyway, that's good for us small investors. And if you'd like to learn more about special situations, if you want to see, I'll probably be getting out of the Seneca Foods next week, so please subscribe if you haven't already done so and you want to know how that one turns out. I'll definitely post a video on that next week if I get out of it. And anyway, guys, thanks for following along, and we'll catch you next week. Thanks a bunch.